Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. Today is Wednesday, the 28th of November, 2007, and the market's closed. Looks like the buyers are back here at the end of the month. The S&P 500 finished with a gain of about 3.25% today. Huge rally, and shouldn't have really come as a surprise that we got a rally. I think the magnitude of it took a lot of people off guard, though, and the fact that it was strong all day. Typically, when a stock gaps up above or the market gaps up above daily R2 and then holds there for a while, then you'll see that it will continue to frustrate short sellers throughout the day. And you can see this is R2 right here, this yellow line. You also see on this 1 minute time frame that the market gapped higher and held that daily VWAP on these first two tests, and then consistently for the rest of the day it did. Sellers maybe a little bit of profit taking at the end of the day, but clearly a win for the buyers today. When we look at the 10-minute time frame, what we've been looking at in here is that this, I thought this little level where the 5-day moving average was and yesterday's highs was the important level to clear. Obviously, that got taken out, as did this high on the open. I was looking for maybe a move up to 145, but that level held, and we just continue to squeeze the shorts higher here. So the what I pointed out yesterday also was this this MACD divergence, and this MACD divergence has really been great for indicating when these little short-term rallies come from in the primary downtrend. But now we've got what's looking more bullish, really, here on the intermediate term time frame, and that is that we broke this downtrend. We're back above a rising 5-day moving average now, and I think that you're going to start to see that pullbacks will be contained by that rising 5-day moving average, at least for a little while, similar to the action that we've seen in Google. Now, if you remember, a couple of weeks ago I pointed out the divergence in Google, and then the stock crossed above this little level of resistance. It broke past that level, tested it, as it also tested the 5-day moving average, and then continued higher. We saw a pullback to it 2 days ago, and then a bounce once again. Now, people are looking for a fill of the gap. Gaps don't always get filled. Don't wait for a gap fill. What I think you want to see on the S&P is a pullback, maybe as low as that 5-day moving average. But I think it's going to take a couple days, and we'll probably see, not probably, but hopefully we'll see a pullback down towards that 145 level. If you took a look at the longer-term picture that I looked at the other day of the S&P 500, I was pointing out that we've been down about 7 weeks now, and the market's been due for a rally, and a lot of times these rallies will come up towards about that 200-day moving average, which we now find at 148. Well, we're getting there very rapidly. Maybe we continue higher. Maybe we come up and meet the declining 50-day moving average. All I know is I don't want to step in front of this type of strong momentum selling. You can look at the volume and say, doesn't that give us reason for caution? And yes, it does give us reason for caution, but it doesn't give you reason to sell short and step in front of this freight train, because you'd be down really significantly had you been selling short today. If you can't accept what you see on the screen, if you think that it doesn't make sense, the market doesn't always make sense in the short term. It trades emotionally, and today was the turn for the short sellers to get smashed pretty hard, and they did. If you look at history, this is the chart of the S&P 500, the spiders, in 2000. And in 2000, we broke below that 200-day moving average. You can see that here, and then rallied up to that declining 200-day moving average. We also had the 50 cross below it. But here's what happened. I look at the magnitude of this rally. This was the start of a significant bear market, but it had a very significant rally. And when you look at it on the monthly time frame, it barely gets swallowed up in there. But it was still the beginning of a bigger decline, and there's still the potential that this market will again turn lower. I think that's really the more likely scenario, but you have to keep an open mind, and today's action should be really put an exclamation point on that statement. I said that yesterday. You have to be open-minded. The recent test of this, the frequency of the test of the 5-day moving average, similar to the frequency of the test of any level of resistance. The more times it's tested, the more likely it is to fail to hold that market back. And now we've got this strongly trending higher market. So you have to look at that and respect the move in here don't get in the way. Even, I mean, look at the 1 minute time frame, really showing very little sign, in fact no sign of weakness. It couldn't even make a lower low in here by breaking this level. So don't be early to sell short. Wait for these gains to be digested and wait for that 5-day moving average to flatten out and turn lower again. If you're starting to sell short, I think you're early, and I think you're probably regretting or will regret your moves in here. The semiconductor index yesterday, I thought that, again, it looked like there was no reason for it to rally, but if it got above 412, I thought that that's where a squeeze might develop. And in the semiconductors, that's exactly where it took off. Not that that was any great insight. It was obvious by looking at that. But we did have these higher low. The market took out that level, and this was more tradable, perhaps, than the S&P 500. The IWM, we've seen the Russell 2000 testing the 73 level, and that is just further adds to the significance of that it's continued to hold there. I think if you get another test of that 73 level after a lower high, what you'll see is these lower highs coming down, and then a break below it. That could put the put the lights out for this market. But let's trade what we see right now and not worry too much about these potential scenarios. I still think this market has the potential to get up to at least the 78 level is what I was thinking yesterday would be. Wouldn't be an unlikely level for this market to rally up to. Maybe it even heads up even higher, up towards that 80 level, where we have the declining 50-day moving average. The trend is still lower here. 1 day, even if it is a 3.8% rally in the IWM, 1 day does not do anything to reverse this downtrend. So continue to be careful. I still think it's a trader's environment. We didn't get that inverted head and shoulders pattern to develop that I was hoping for, but when it broke that trend line and above that 5-day moving average, buyers took control, and now they closed them right near the highs there too in the IWM. We've got a rising 5-day moving average, benefit of the doubt in the intermediate term, and then when I say intermediate term, I mean probably the next 2 to 5 days. It goes to the buyers in here. There will be pullbacks, but I think that we ran out of a source of supply for this market to push it lower, and the buyers came in, started nibbling last Friday in the half day, and a lot of people thought, well, it's low volume because of the holiday, and it was low volume, but sometimes the market catches a lot of people off guard, and that's exactly what we had in here. We were watching in the Qs. Monday, I was pretty confident that we would test this 200-day moving average this week, I said. And I pointed to the descending triangle that was forming here, and yesterday, fortunately, I pointed out that patterns do fail, and you have to be aware that there's the potential that if this market does get moving higher, back above this level in particular, that there was a good chance that we would see a short squeeze rally develop. It was really, like I was saying, it really had to complete the descending triangle pattern. It had to break down below 48.80. Hopefully you weren't short this market, and if you were, hopefully covered very quickly and didn't add to your gains, to your losses rather. As I've been saying, you've got to be very quick, very aggressive to manage your positions in this market when you have such big volatility in it like we do now. Yesterday, again, I was pointing to the pattern failure also in Baidu. A lot of people were pointing to this, very obvious head and shoulders pattern, and people were getting short in here for Baidu, but Baidu did not break below that neckline and make the low volume return move and then fail. That's the way you want to trade a head and shoulders pattern. You can anticipate it. You can anticipate where a move might unfold and look to see, kind of develop your plan, but you don't participate until price confirms what your theory is saying. For instance, on the descending triangle, I was anticipating that it would likely break down below that 48.80 and complete this pattern, but unless price breaks down below that level, there's never a reason to take the trade. Leave that to the institutions. If you're going to trade these things, then be a trader. Listen objectively to the message of the market, and if you don't like the message that the market is telling you, don't fight the message. Just stand on the sidelines and wait patiently for a market opportunity to present itself that does make sense to you.